The United States is stepping into a new economic era, marked by significant changes and challenges. This shift is primarily driven by the Federal Reserve's recent decisions, which have profoundly affected both Wall Street and personal finance across America. In a little over a year, the Federal Reserve has escalated the federal funds rate by an extraordinary 500 basis points, signaling a departure from the environment we've known for the past 15 years. This rapid increase in rates, a response to the Fed initially lagging in addressing economic pressures, has introduced various risks and distortions in the financial landscape. For individuals and entities who have borrowed money, whether for purchasing equities or real estate, the quick hike in interest rates poses potential risks. Assets could decrease in value, underscoring the dangers of not treading cautiously in this new financial climate. This reversal from zero interest rates brings with it certain pains, prompting a reflection on the true cost of initially low rates. It's akin to enjoying a drink, only to face a harsh hangover the next day, making one question whether the initial pleasure was worth it. Looking ahead, barring any major catastrophes, a return to zero interest rates seems unlikely. This raises critical questions. How is the U.S. economy adjusting to these higher interest rates? And are we yet to fully witness the impact of the past decade's liberal monetary policies at the Federal Reserve? The decisions of the Federal Reserve profoundly influence America's cost of living. By adjusting interest rates, the Fed can impact inflation, job prospects, and much more. As the nation's central bank, its primary tool for influencing the economy is the benchmark interest rate, akin to a lever in a machine controlled by mechanics. This lever, representing interest rates, affects all gears of the economic machine. Currently, with interest rates above 5%, the Fed aims to decelerate the economy and combat inflation. Recent data shows improvements in inflation rates, suggesting the Fed's measures are taking effect. This is crucial, as a stable economy benefits all, especially since an economy riddled with rampant inflation doesn't work well for anyone. In periods of low inflation, central bankers have had the latitude to reduce interest rates to record lows. Such an environment typically results in more jobs, benefiting lower-income workers. A hot economy can be particularly advantageous for marginalized groups, helping narrow long-standing wage differentials across different demographic groups. Low interest rates often make it easier for workers to secure raises. However, they also tend to exacerbate wealth inequality. In a thriving economy fueled by low rates, more people enter the workforce and job creation surges, potentially reducing wage and income inequality. Yet, this same environment can lead to increased wealth disparity. Low interest rates often elevate the value of other assets, leading to a rise in wealth inequality. This intricate balance between interest rates, employment, wealth, and inequality highlights the complexity of the Fed's role in shaping the economy. The impact of these policies is far-reaching, affecting everything from individual job prospects to broader societal disparities. For nearly 15 years, central bankers in the United States have maintained interest rates near zero, sparking a significant debate among economists. The critical question is whether this zero interest rate policy is beneficial, detrimental, or simply the best option available under the circumstances. Such an extended period of zero interest rates is unprecedented and unexpected. Referred to as the zero lower bound, this approach was historically adopted by major central banks, including the Fed, to combat deflation, which is characterized by declining prices leading to economic stagnation. The Fed's motivation for this sustained stimulus was to invigorate the economy. In an environment where money is cheap or virtually free, those who borrow and reinvest typically gain an advantage due to the low cost of borrowing. This has been particularly true for private equity firms, leveraged buyout firms, and real estate investment trusts, which thrive on leverage and borrowing. During the 2010s, the economy witnessed steady growth, fueled by increased cash flow into risky ventures, startups disrupting sectors like transportation, housing, and technology. However, with today's higher interest rates, some companies struggle to cope. In the first half of 2023, the U.S. saw the highest number of corporate defaults globally, totaling 41. The shift to higher interest rates presents new challenges. It becomes more difficult for startups to secure financing, and the hurdles for buying a home increase. The real question is not about the presence or absence of zero interest rates, but whether the current rates are too high relative to the market's demand for money. Banks and investors keenly observe the Federal Reserve's actions, understanding that adjustments in interest rates have far-reaching implications for entire sectors like technology and real estate. These changes ultimately resonate through Wall Street and impact the banking sector. In an era of low interest rates, mortgage rates tend to be lower, increasing people's borrowing power and driving home purchases. This principle extends to commercial real estate as well. However, many investments made during the low-interest era are now under strain. Mortgages represent a significant portion of banks' balance sheets, and as interest rates rise, the market value of these long-term assets declines, even in the absence of default risk. This situation presents a challenge. Low interest rates initially encourage substantial borrowing, which seems sustainable in the short term but leads to a potential cascade of refinancing issues in the future. Investments and constructions that seemed viable due to low rates might prove unsustainable. The banking sector is currently facing a substantial amount of unrealized losses, especially in the realm of commercial real estate. A major default in this sector could trigger widespread difficulties across the banking industry. Additionally, banks typically finance these long-term investments using short-term deposits. While U.S. banks hold customer deposits to balance their loans, these accounts are only insured up to $250,000, meaning any excess could be at risk in a bank failure scenario. Experts like Erica Jong and her team are raising concerns about the stability of U.S. banks in this new economic environment. The collapse of Silicon Valley Bank, SVP, highlighted vulnerabilities not unique to SVP, but shared by approximately 10% of U.S. banks experiencing more significant asset value declines. A key issue identified is the ratio of insured to uninsured deposits, which some analysts link to the prolonged period of low interest rates. The Federal Reserve's interest rate policy significantly influences Wall Street's risk-taking behavior. Banks typically allocate a portion of their assets to low-risk investments, often considering government bonds as a safer option. However, these bonds are ideally held until maturity. If banks are compelled to sell their long-term bonds to meet reserve requirements, particularly amidst sudden interest rate hikes, they could face financial losses. Currently, U.S. banks are grappling with over $2.2 trillion in unrealized losses due to these abrupt rate increases. Such a scenario poses a substantial risk, especially for smaller and regional banks, which are likely to experience continued earnings pressure. With high and potentially rising rates, the bank's underwater bonds suffer, and simultaneously, there's a risk of deposit flight. For the average person, this new economic era presents a different landscape. Saving becomes more lucrative, especially when funds are placed in high-yield accounts. The erosion of purchasing power is a growing concern, pushing individuals to seek out savings options that offer protection against this trend. Traditional bank accounts, which have historically offered low interest, are now being compelled to increase rates due to competition from other financial sectors. We are witnessing an environment where finding interest-bearing accounts offering 3 to 5% returns is increasingly feasible. This shift marks a significant change from recent years and is creating wealth effects that haven't been seen for some time. The Federal Reserve often plays an expanded role during times of crisis, with unconventional policies marking significant moments in history. A prime example was the financial crisis of 2007 to 2008. During this period, the Federal Open Market Committee, FOMC, drastically reduced the target federal funds rate from 5.25% in the summer of 2007 to a range of 0 to 0.25% by the end of 2008, reaching its effective lower bound. These measures were aimed at averting a catastrophe akin to the Great Depression, where approximately 9,000 banks failed. Ben Bernanke, then chairman and a student of the Great Depression, was determined not to repeat history. Today, we are experiencing a central banker's shift to a higher-for-longer approach to interest rates. This change limits non-productive investments that are less likely to generate revenue in a high-interest rate environment, contrasting sharply with the low-interest rate period where almost any investment seemed viable due to the negligible cost of capital. This new environment is expected to foster greater business dynamism and entrepreneurial spirit, encouraging more careful and judicious investment decisions. However, economists are considering the potential impact of these investments on job creation, especially in an age where automation is increasingly prevalent. For instance, the effect of higher interest rates on sectors like artificial intelligence is a topic of debate. While some investors view the Fed's 5% interest rates as inconsequential when seeking returns of 100% or more, for others contemplating immediate investments, these rates are significant. Looking ahead, the U.S. labor market is projected to grow by 8.3 million jobs by 2031, indicating a slower pace compared to the previous decade. The Fed's goal is to moderately slow the economy, but this raises the risk of recession. A key debate in this interest rate hike cycle is whether it will culminate in a soft landing or lead to a recession, and the outcome remains uncertain. Remember to like, subscribe, and comment with your views on the Fed's unconventional policies and their long-term impact on the economy and job market. How do you think these policy changes will shape our future? Stay tuned for more in-depth discussions on the interplay between monetary policy and economic growth.